nearly over 40 or 40 plus people on the call. So we'll go ahead and get started. First of all, I just want to thank Cindy Donahue, our Director of Marketing, for organizing all this and putting together the invitation and sending the invites out. Also want to thank Leon Hayes and Richard Denny for sponsoring the Ignite Talks series that we have. And then today, also thank Martin for participating in this. I think, those of you who are interested in either being an active angel investor or contemplating taking angel capital, you're going to find Martin's background and his process and the way he invests in companies and brings others into his syndicate to be highly fascinating. So today we're going to talk a little bit about Martin's background, his current angel activities through his firm, Incisive Ventures, his criteria, including his 7 meta themes, how he goes about building syndicates on angels list, some of his representative investments, including companies in the Spokane area, and then some of his thoughts about Spokane. Martin actually moved to Spokane from Seattle in the last couple of years, and I think we'll kind of benefit from some of his thoughts on why he moved over here and what he thinks about it. But first of all, we'll kind of just kick off with I'm gonna read a little bit of a summary here about Martin.
Oh boy.
Well, it's your words, Martin. It's from your website. But, Martin has created over $3 billion in equity value, raised over $500 million, including a NASDAQ IPO, and generated hundreds of millions in revenue. As an investor, he's been a venture partner, a limited partner, and an angel investor in over 80 early stage companies, including companies that you may not have heard of, but I'm going to mention them anyway: Google, DocuSign, Tesla, Ignition Partners, RRE Ventures, and Unlock Ventures. Now, those are all kind of interesting, career and angel things. But the other more interesting things about Martin is he now focuses full-time on his family, private equity investing, writing, surfing, motorcycle riding, and biking. But even more interesting than that is he's owned a handful of bars, restaurants, and a very fun live music rock club, and once starred in a documentary titled Biker Dreams. So this is kind of not your average angel investor that we have here today. So I'm gonna kind of prompt Martin with questions about his background, and we'll learn more. But I really do hope that everyone will chime in with questions, put them into the chat, and then I will call on you. But with that, I'm just going to kind of turn it over to our interview here. And I gave a high-level overview of your background, Martin, but maybe you can kind of fill in the gaps in a timeline, kind of starting off with your educational degree in Oregon, and then you started with Ignition, Microsoft, and then all the way up to today. Then we'll get into the other stuff.
Sure. Well, thanks for that. And I'd forgotten I'd written some of those things. Maybe I should go back and update my bio, some of those things. So, I've kind of always been a capitalist. I started my first business when I was 5 years old with a Kool-Aid stand. Our house was in between a parking lot and the University of Florida football stadium. And I noticed on the weekends that there were tons of people walking from the parking lot to the stadium. And I asked my mom, could I sell them, Kool-Aid and make some money on the weekends? And she's like, sure, why not? And I made like $80 the first time I did it. I was like, this capitalism thing is pretty cool.
But did people drink the Kool-Aid?
They drank the Kool-Aid, yeah, and tipped too, some cute kid, they're always going to tip the kid. So I've kind of been on that, how to make money or how to, little businesses, my whole when I went to college in Oregon, I was living in Medford, Oregon, and I went to Oregon State. I actually wanted to go back east, but we didn't have any money. I was admitted to some better colleges back east, but we didn't have any money. So I went on scholarship to Oregon State, and I didn't really know what I wanted to study. My brother was studying nuclear engineering, and I said, that sounds pretty hard. Let me try that. And I got in there and there were no girls in the classes. I said, this is terrible. So I went over to the business school where the women were, but it wasn't hard enough. So I found some computer science classes, and I'm like, I really want to learn about computers. My father had started programming some computers. And so my first computer course, I actually wrote, I'll tell you how old I am. It was writing computer programs on cards in a deck VAX. And the biggest problem you had with that was if you dropped your stack of cards, your program would get all messed up. So I double majored in business and computer science because what really interested me, whereas a lot of my friends were interested very much in the purely technical issues around computers, I was interested in solving business problems with computers, spreadsheets and, finding ways to make businesses more efficient using computers. So that's why I double majored in computers and business. And I worked in a PC store during college selling PCs to pay for college. And then I went to Anderson Consulting, which was then ended up being called Accenture right out of college because they had a really good training program. When I look back, it was really exciting to get a job for $19,000 a year of salary back then. But they paid overtime, so that was good. And so I went for work for a couple clients in Seattle, the last one being Microsoft. And I was at Microsoft for 2 years, helping them figure out new AR, AP, and GL systems for their international subsidiaries. And, Microsoft's not dumb. They did the math and figured they could hire me cheaper than pay me as a consultant. So they made me an offer. Turns out, I delayed that offer for a year because the partners at Anderson were telling me what a great career Anderson was and how this tiny little Microsoft would never make it to anything. That year probably cost me $100 million, but I don't hold it against the Anderson people. So I went to Microsoft for a while in the IT department and worked there for 6 years. I was there before the IPO and left after Windows 3, which was really a great time to be at Microsoft. But when my last job there was in channel policies, and we were designing the volume licensing program for Microsoft, which was the initial technical infrastructure that led to the digital certification of all Windows licenses over the internet. They started in the enterprise, selling CD-ROMs and then having a separate piece of software that verified the installations against the license agreement. And that infrastructure, which I helped design, ended up becoming what everybody uses now, which is every software instance having a license and being verified to a server in the cloud. But in doing that, I worked with a ton of startups that were in that field of digital software distribution. And I got really interested in startups and investing in startups. I joined the board of a couple startups and I said, this startup thing can't be that hard. So I left Microsoft and started Loud Eye Technologies, which was an early service provider in digital media. Microsoft had their Windows media format. Real Networks was just starting with their audio format. And we became a service bureau converting traditional media formats, CD-ROMs, videos, and things like that into the multiple digital formats, and then writing applications to use them. We were the first back end for Apple's iTunes. Our servers were the actual servers that were downloading the music. We created the first 30-second music sample library that Amazon and all the other retailers used to preview songs before people bought them. We took that company from nothing to a $2 billion IPO in 4 years on $10 million of revenue. It turned out to be the last IPO of the dot-com boom. We went public in March 17th of 2000. The peak of the NASDAQ was March 21st. Turns out timing has a lot to do with good outcomes in venture. If we had been 5 days later, we probably would not have been able to go public. So, that was Loudeye. I really, wasn't excited about running a 300 person public company. So I got a CEO to replace me. And, Loudeye's stock sort of followed the general NASDAQ. But it was a good outcome for all the investors. I think my investors made 300 times their money or something like that, the first investors. So after about a year after the IPO, I thought I would retire, and basically went from working 80 hours a week to working 0, which I don't recommend anyone do. It's a bad idea. I was married and had a kid, and it was great. But after a year of watching Teletubbies, I said I have to get out of the house. And I called a couple of my friends who had started Ignition, some Microsoft guys, Brad Silverberg and Cam and those guys. And they said, we need more operators like you who've started companies. Why don't you come over here and be a venture partner? So I went to Ignition for 3.5 or 4 years as a venture partner. I did 4 or 5 investments there, and sat on some boards, working mostly with Cam and Brad. And that was a lot of fun, but I also realized that that being an investor was very different than being an operator. I mean, you're not running the company. You have to basically trust the management to run the company. And I wasn't sure that I, wanted to be long-term a venture capitalist. I also got very interested at the time in renewable energy. And I found a couple companies to invest in, and I brought them to Ignition. And one of the things I learned about venture capital partnership is that they tend to have a very specific area that they like to invest in. And Ignition liked to invest in enterprise software, things that Microsoft or Cisco might buy. And so this whole idea of clean tech was outside their thesis, and they just basically weren't going to do any of those deals. So I said to myself, well, if I want to, invest in clean tech, I might have to do that myself. So I started writing checks myself into clean tech deals. And one of the companies that I invested in was called Imperium Renewables, which had this idea of creating a more efficient biodiesel refinery. And biodiesel is a plug compatible fuel that replaces diesel fuels. And I bought enough of the company and liked the CEO that he asked me to come and join the company. And, I thought, hey, I can learn, industrial production, it can't be that hard. So I joined that company as CEO. We ended up raising $250 million, building the biggest biodiesel refinery in the world in Grays Harbor, Washington. And we had it on on file with Morgan and Lehman to go public in the fall of 2008. And unfortunately, with that one, we ended up missing the IPO window. The IPO window closed before we could get it public. So, I left that company because they weren't going to be growing that much anymore. It eventually got sold. But one of the things I learned in renewable energy is that it's, your opportunity is great when, oil is $140 a barrel and the cost of your feedstock in biodiesel is, $20 a barrel. When oil delevers back down to $40 a barrel and the subsidies go away, the economics of your business can change very dramatically, which happened in biodiesel. So anyway, I still stayed very interested in funding renewable energy companies. So I started Element 8, which is a renewable energy angel group over in Seattle. And they're still running. They have a fund. I think they've put $60 or $70 billion into clean tech businesses. Anyway, after Imperium, I took another year or 2 off, and then decided I wanted to run another company. And I called my friend Stuart at RRE Ventures, where I was an LP, and said, I've got this crazy idea of doing a marketplace for free goods. Do you want to fund it? And he wired me $5 million the next day without a term sheet. So that was pretty fun. And I started Cashless that ended up turning into Tipper, which was a daily deal infrastructure white label company that competed with Groupon. We sold the software to Microsoft and a bunch of other companies to do their own daily deal businesses. That, what I learned from that business was, that was a good new business, but if you create a new category, you want to be the guy who creates the category. You want to be Groupon. The guy who follows along in the category ends up not getting as much economics as the category creator. So we ended up selling that business, and it was an okay outcome. Then what did I do after? Since then, I took another 3 years off and spent mostly time with my family, did more investments directly. I met this guy, Dave Asprey, who had started Bulletproof Coffee. And he seemed like a really smart guy. And I was having dinner with him, and I said, oh, I don't know anything about consumer packaged goods, but are you raising money? And he says, yeah. And I got out my checkbook and I wrote him a check without even seeing a business plan. I don't do that anymore, by the way. I don't recommend it. But it turned out to be a good investment. Dave's a really smart guy. And we became friends, and he had this idea that he wanted to spin out from Bulletproof, which is basically a consumer packaged goods company, selling coffee and fat water and protein bars and stuff like that, a health and fitness company operating biohacking facilities, sort of next generation workout facilities and conferences and training in LA. And he said, the first location is in Santa Monica, 2 blocks from the beach. And I said to him, Dave, next time just say Santa Monica, and it doesn't matter what you say after that, I'm in. So I agreed, really just as a friend, to help him start this company. That was about 4 years ago. I came down to LA. We opened 2 locations. I raised about $17 million. We had 100 franchisees wanting to build more locations. We were doing about $700,000 a month. In March, when the pandemic struck, we were forced to close all of our retail locations, and we went from $700,000 a month to 0 in 2 days. So it turns out running a retail location and a conference business where you need 2,000 people in a room during a pandemic is not a very good business. So that was March of last year, and I had already been in LA for 3 years, and I only planned on being there for 2 years. And so I told Dave, I said, listen, this thing isn't going to grow. We were actually also in the middle of a financing. We had a $15 million term sheet that had been signed. And of course, the investors just ran away from that in the middle of the pandemic. And I said to Dave, listen, you need to recapitalize this thing and run it as efficiently as you can. You don't need a guy like me to raise money, because I can't raise money. And by the way, I'd rather be with my family during this pandemic. So I got on one of the last Alaska planes out of LA direct to Spokane, and came back here. And the reason I ended up in Spokane is that I had been living in Seattle, but my girlfriend, who I've been with for 10 years and we have 2 kids with, had moved to Spokane because she's from Spokane. She's actually from more like around Brewster, but she had lived in Spokane. Her mom and her brother and sister were there. And, she's like, it's going to be a lot safer during a pandemic to be in a town like Spokane than LA or Seattle. So I'm like, okay. And came up in March, and we got married and bought a new house. And I've really, how I ended up getting, this is gonna be a little longer explanation than you wanted, but how I ended up doing investments is, after I was no longer running a company, I had to decide, what am I gonna do with my time? Am I just gonna swim with the kids in the pool, or do something else? And I actually went through and looked at all the things I'd ever done, to make money or to grow companies or, hobbies or whatever, and kind of ranked them as, things that were good financially and also things that I enjoyed doing. And, I didn't really know what kind of company I would start myself again. And I also didn't really want to work 80 hours a week as a CEO. And the second best thing that I've ever done that I've enjoyed and has also been financially rewarding has been direct angel investing. I went through and you mentioned that I've invested in 80 companies. I've invested in over 200 by now.
Well,
and when I compare my
website,
yeah, I need to update my website. When I compared my returns doing direct angel investments to investments as an LP in venture funds, and I'm an LP in 12 venture funds. I love the venture business, it's a great business, but my direct investment portfolio has outperformed my LP interest by 3 times. And I think part of that is related to the stage, investing a little bit earlier. But I was like, why don't I do more of that? Because it seems like a decent return. Plus, it's the kind of thing that you can do, a little bit part-time, as long as you're not a partner at a venture firm where you've got staff and LPs and all of that. And so I started doing that, and a bunch of my friends that I had done deals with before said, hey, we like what you're doing. We'd like to help you out. Is there an easy way to share deals? And in the past, to do angel deals, you had to go to meetings, like you've had, or like we had at Element 8. You get a pitch deck from a CEO, you send it around to your friends, you have them meet the CEO, and it's really inefficient and kind of herding cats to get everybody together.
Hey, Mark, and before we go into kind of how you build syndicate angels list, well, I think it's. Talk to me, tell us a little bit about your criteria.
The criteria.
You have, if you're doing 3x better than the 12 venture funds, you've locked in on a model that seems to work. And in reading some of your things, you talk about the value of a counterintuitive thesis. You have 7 meta themes.
Yeah.
You have a handful of things that you've made mistakes in the past. I think, why don't you elaborate on some of those things? Because, I think they're really fascinating, very informative. And anybody on the call here that either wants to become a more active angel investor or is seeking capital, I think these themes and this criteria will be very informative.
Sure. So they're on the website, the 7 meta themes, and I ended up creating those because when I said to myself, "Hey, I want to go back. I want to do more investments." The first thing I had to do is to go through all my prior investments and try to figure out where I was any good. When I, just wrote a check without doing any diligence, it turns out that I wasn't as good as when I had particular themes that I had been following. And those 7 meta themes came out of my analysis of all the investments that I'd ever done and the ones that turned out the best and what I knew at the time, or what I thought at the time, versus what ended up happening. And let me give you an example, of a counterintuitive thesis. And so I really only invest in software companies that are going after a blue ocean of opportunity, hopefully creating a new category, and not directly competing in a red ocean with a lot of other competitors. Anything which allows Americans to be lazy, which I think I'm the only investor that invests behind things that enable people to be lazy, and where I can personally be helpful to the company, and where there's lots of other very smart people. And let me give an example of that. I was one of the early investors in DocuSign. And at the time when Ignition wrote the check into DocuSign, everybody was signing contracts with faxes and, notaries and stuff like that. And in fact, digital signatures were not even legal in contracts. And so it was very counterintuitive to say software is going to eat signatures because they were illegal. And frankly, that was a very long process. The company almost died like 3 times, and it took a lot longer to change the regulations than people thought, despite the technology working. But the counterintuitive thesis that people would prefer digital signatures because they took out so much friction. The underlying issue with digital signatures is they make it so much easier. They take so much friction out of contracts that they were going to be preferred over time. And that's turned out to be correct. But at the time making the investment, it sounded pretty freaking crazy to do, especially when they were illegal.
Yep. That's another one I missed, unfortunately. I looked at DocuSign early on and wasn't as wise as you were. For giggles here, I am going to read the 7 investment themes just real quickly.
Okay.
They're all on Martin's website, and we've shared the link here, and it's great reading. But the 7 themes are: software eats everything, great founders figure shit out, disruptive innovation creates new markets, platforms win, Americans are lazy, invest only when I can be helpful, and invest alongside other very smart, committed people. And again, on the website, Martin elaborates on each one of those.
Yeah.
Then you go further into it and you kind of talk about a funnel, about how you then got to further evaluate deals. And you say you want to have a greater than 80% confidence in a 10x return. And I think that's really informative that, early stage investors, they want to figure out how they can get 10 times their money. And you, as an entrepreneur seeking capital from a sophisticated angel investor like Martin, you need to kind of be able to demonstrate how you're going to do that. But then you have a weighting, Martin, on management, product, market, regulation, and terms. Maybe you can kind of just, briefly address that as well.
I do, and I haven't really published that that much. I know I follow this guy on Twitter that published his angel algorithm. It's a 20-point score, and he shows the weights and stuff like that. I'm thinking about publishing mine, but generally, when you're obviously, if you look at angel investing or venture investing, the power law applies. If you invest in 10 companies, the averages are going to tell you, 7 or 8 of them are going to go to zero. And one of them is going to, make the entire return of your portfolio. So when a power law applies like that, what your job to do is to, invest in the highest probability outcomes of that power law. If you believe you're going to make 10 times your money every time you write the check, you are unlikely to make 10 times your money every time you write your check, but at least you're making a big swing every single time you write a check. I think some venture investors say, well, this looks like a 2x and it's fine. The problem is you're never going to make the kind of returns to balance out the risk you're taking by making 2 or 3x bets. So then if you have to make bets that can make 10 times your money, or then you have to ask yourself what criteria relate, and I created the criteria by going back through the 100 investments and saying, of the 100 investments, the ones that ended up making more than 10 times your money, what were the characteristics of those companies at the time I made the investment, not at some future, blue, crazy, good, positive thing that happened, but what were the things that were present when I wrote the check that correlated to this higher outcome? And those were things like management. In an early stage company, the management in my weighting is 50% of the value of the decision, because most companies end up pivoting. All companies have problems, challenges with product development, customers, blah, 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 blah. And it's really management's ability to execute, ability to be resilient, ability to pivot and adapt to the evolving market, which makes the difference. Because with so much money being out there today, there are many, many companies attacking similar problems and markets. And the difference really is management's ability to execute. So you really have to sort of get to know management and make a strong bet on management. I tend to, and then one of my criteria is regulation. It's about 10% of the weight. And a lot of early stage investors don't consider regulation. But as you and I were talking earlier, one of the reasons I don't invest in biotech is because the regulation risk in biotech is probably 50 or 70%. of the problem, because you could invent the greatest thing since sliced bread and regulators don't approve it. You have a huge regulatory risk. And there are many software businesses that have regulatory risks that are not really understood. For example, DocuSign, when we wrote the check, digital signatures were illegal. If that didn't get changed, there would be no market at all for digital signatures. I've looked at lots of electronic voting things over the years, and my call on that was that, regulation around electronic voting would never turn in favor of electronic voting. And it still hasn't yet. So, regulations, another key criteria. One error I see a lot of investors making is overvaluing the co-investors. I like to invest with other smart people, especially in a category where I'm not an expert. I just invested 2 weeks ago in a SaaS software company for charter airlines. I don't know anything about the airline business, but there were a couple investors that really did know a lot about the airline business. But in my weight, co-investors are 10% of the value. I see a lot of angel investors making co-investors 50, 60% of their value. They're saying, oh, Andreessen Horowitz is investing, therefore I'm investing. And in my mind, a co-investor is a secondary signal versus a primary signal. The primary signal should be how good is the management, how good is the market, and what is the regulatory risk.
I like what you said, and one of your themes is invest alongside other very smart, committed people. But then you really broke that down and said alongside smart and committed. Because a lot of early stage companies will attract capital from name brand firms, but if they're not really involved in rolling up their sleeves, it's completely meaningless.
Exactly. Yeah, I remember looking at a company 2 years ago, and the CEO, the first slide on the CEO's presentation is Peter Thiel is investing. And I said, well, that's a big name, smart guy. How much did Peter Thiel give you? $250,000. He probably lost that in his sofa and didn't even know. And I asked the guy, I go, oh, so, you talked to Peter. Well, no, it was one of his guys. Which guy? Oh, it was actually an associate. I would bet you Peter Thiel had no idea that check had been written. And yet the CEO had his name plastered all over the presentation like he had been anointed by Peter Thiel. That's a mistake.
Great story, but that is so true. Very, very good story. Then also on your website, you can talk about some, not everything is perfect. I know not every deal you invest in works, although you've got a great track record, but you do talk about major errors that you've made. And you list 5 of them: weak management, underfunding, big market, unclear entry strategy, Me Too products, and then following investors without a personal theme fit. Any of those that you want to kind of just highlight and elaborate on?
Well, I personally experienced the Me Too product, having, a white label version of Groupon, and, Groupon had created the category. You look at the same thing happened in digital signatures. DocuSign, I forget the exact numbers, they're worth 20 or 30 times the number 2 player in the category because they created it. So, if companies are saying we're going to be the X of Y, or, the fast follower behind whatever, I'm always very skeptical, because the fast follower gets an order of magnitude less valuation and attention than the category creator. You can't always invest in the category creator, but when you can, that's when your probability of a 10x return is much higher than if you're investing in, number 2 or 3 player in the market. So I'm always, the other one that I would like to talk about is, the thin edge of the wedge, or the market entry strategy. Whenever I see a company with a Gartner slide, And obviously they're always in the top right-hand corner. And I asked them, why are you in this market? And they say, because Gartner printed a report and it's supposed to be a big market. I am an immediate pass, because that CEO is unlikely to be solving a very personal problem. He's, following a meta trend. And what makes the difference is you have to actually have some unique insight into the market, into a personal market entry. So, people say, cloud computing is a huge market. Great. So what is the product you have that is going to add value uniquely in that market, that is built on something uniquely or advantageously versus all the other competitors? And why do you know that customers are going to buy that solution? That's one of the things to get to one of my investments. I think Chris is on the call. That's one of the things I love with Chris and Vega Cloud, is that he had 10 years of managing cloud infrastructure with people through a managed service provider. And he said, I'm going to create this software platform that can, manage cloud infrastructure across vendors from a single dashboard. And the reason I know people will buy it is because this is a problem I've had for 10 years. So it wasn't just cloud is big, it's, we have a specific solution to solve a specific set of problems that we deeply know and understand. And many companies, especially early, don't have that specific thin edge of the wedge that is going to get them into the market.
Got it. Well, that's a great summary of your criteria and how you evaluate opportunities. I want to transition next to your involvement with AngelList. But before I do so, we have one question from Carter. And Carter currently works with a company that came out of Y Combinator. And now he is in the process of also launching his own new company. So Carter, do you want to ask your question?
Yeah, absolutely. So I'm curious to hear, as an investor, what you like your involvement with the company that the companies that you're funding to look like, how active you like to be, and what activity that looks like on your end.
Well, being an angel investor and being a $200,000 to $500,000 check, I am always following. I'm never leading around. So unlike, I think Tom sits on boards and, regular venture capitalists can lead rounds. I'm never going to be leading around. So, I'm not going to be sitting on boards. But the reason I think a lot of CEOs are starting to prefer or make allocations for guys like us is that there's a huge amount of value to have investors who've been operators in a similar category to just help sort of on the advisory type thing. I always, even when I listen to a pitch from a company, even if I'm not going to invest, I always try to connect that company to somebody else in my network and try to give the CEO some sort of a value for their time, because really it's making those connections that improves the value of the whole ecosystem over time. So, depending on the company, there's actually the biggest investment I made so far, and I think Tom joined it too, is a company out of Seattle called Catalyst. I put $1 million into Catalyst, but that's a fitness company where I actually had some very specific experience, some partnerships, some other venture capitalists, some health and wellness influencers. So I'm spending actually quite a bit of time with them, in part because it's a very big check for me, $1 million, and in part because I have a very highly leverageable network that can help the company grow. As an investor, I always want to add more value than just my money, and the CEOs who raise should expect that from investors because it's a cash-rich environment, and you should choose the investors that are going to do the most. And I find that operator angel investors tend to spend even more time, helping their companies than a lot of the bigger name VCs do, because the bigger name VCs, don't have as much time to focus on the companies.
Thank you, Carter.
Awesome. Thank you.
Now, Mark, let's transition to Angel List.
Mhm.
And you kind of talked to me about, how that works, how you bring deals to Angel Lists, who can participate? Do you have to be accredited or not? What's the dollar amount that people can put in? And how the reporting issues, what it means to the cap table of the company, all of those topics.
Yeah. So I started, in my background saying, I've done, 100 angel investments direct, and in the past, when you were trying to help a company raise money, you just had to send the deck around to your friends, have people, and it was pretty inefficient, herding cats. And when I started to write checks, I have a personal allocation of about $2 million a year that I'm writing into early stage companies. And when I started telling a bunch of people that I was doing that, a lot of guys said, "Hey, I want to invest in whatever you're investing in." And the old way of just sending them the deck and saying, "Call the CEO and do your own diligence," was inefficient. And so I had been an investor on AngelList, and I'm like, maybe I should start a syndicate, because it's actually pretty efficient with AngelList to just post. When I write a check, even if I'm just writing a check myself, I actually write an investment memo for myself, just because I'm a nerd like that. And to post that on AngelList and share it with my friends was very low amount of work. You don't need an entire venture capital firm with associates and office space and all that stuff to do that. So I started doing that with about 50 of my friends because they just said, "Hey, I would like to, if you're going to write a $100,000 check, I want to see the deal. I want to see your diligence. I would like to consider investing in that too." So the first 4 or 5 deals I did were just me and sort of 40 or 50 of my friends sharing deals through AngelList. And the way that works is you have to be an accredited investor to be a member on AngelList. The other thing that it does, though, normally a normal angel check from an individual investor is $25,000 or $50,000. On AngelList, you can write a check as small as $1,000 into a syndicate. And if you have enough people, you can put $100,000 together, with relatively small checks. And as an angel investor, you can spread your bets. If you have a $25,000 allocation to angel investing, you can do a lot more than one company through AngelList syndicates. So I started, doing that, and it's my very first deal on AngelList got approved for AngelList fund investing and for their private capital network, which is their highest net worth individuals. And what that did is got me like 300 new syndicate members overnight. And apparently Incisive Ventures is one of the fastest growing syndicates on AngelList. In 6 months, I have over 1,000 investors. Probably 950 of them I don't know personally, but they're people that have read my blog post, have followed the kinds of deals, like the themes, and want to see the deals that I'm doing. And the last 5 deals that I've done have all been significantly oversubscribed. And the way it works on AngelList is you have an account on there as an LP. If you're a member of my syndicate, when I have a new deal, you get an email, you see my diligence, you see the company's deck, you might see a chat or with the CEO, some Q&A, and then you can push a few buttons and invest if you want. If you don't, you don't have to. You can pass. There's no problem. And for that, you agree to pay a 20% carry to the syndicate manager for that if there is an upside. If the investment is a loss, there's no fees to manage that like there would have been in a venture capital firm. So it's a very low friction way to share deals. When I originally started the syndicate, I thought I would write, 4 or 5 checks a year. I've closed 10 deals for over $3 million in the last 6 months. So it's turned out quite well.
So if people invest with you in these syndicates, a couple of questions. What sort of reporting do they get after the fact? How are they able to monitor their investment? And then number two, does their name show up on the cap table of the company, or is it somehow consolidated into one entity?
Good questions. One of the beautiful things, both from the company perspective and from the investor perspective, is that what AngelList does is they technically create a special purpose vehicle, a single unit entity for every syndicate. So if I have a $500,000 allocation in Catalyst, like I had in the first time, on the cap table, there's one line item, which is called Incisive Ventures LP Catalyst or something like that. So the CEO gets one line item on their cap table. And it's a lot easier for them than if they had to talk to 50 investors and close, $15,000, $20,000 a piece. It's just simpler for them, for their perspective. They issue one, K1 to that entity. And then AngelList has all the office backend infrastructure where they know that $500,000 is split between all these investors at all these different amounts. And in your account, you'll see the amount you have in that investment, and you'll get a K1 for that pro rata share of that SPV for you. And AngelList actually does a really good job of creating consolidated K1s. So I have, I don't know, maybe 100 investments on AngelList. I get a K1 from AngelList that shows all of them, and they handle all the accounting for you. And if that investment ever is sold or marked up, AngelList handles the markup and the redistribution of funds. So let's say that, Catalyst investment, $500,000 is worth, $10 million someday. If those shares are sold, that $10 million.
Better be more than 10 million, Martin.
It's going to be worth way more than 10 million.
Okay.
Yeah, way more. But those funds, when those shares are sold, those funds would go to AngelList. AngelList would handle all the accounting and redistribute those funds back to the individual LP members' accounts. So it's incredibly frictionless, and they handle all the accounting, all the K1s for you, and you can always see your portfolio in AngelList. And every time a company does a markup or raises money at a higher valuation, you see your value in that company go up. I mean, I did a deal 3 weeks ago called Portside, the software for charter airlines. We invested in a safe at a 16 pre. 2 weeks later, they signed a term sheet with Tiger at 55, raising 20. And when that deal closes, all the investors who invested at 16 pre will see the markup in their thing of, a 4x markup in a month.
Yeah.
And, the carrying cost will be reported by AngelList that way.
Incredibly efficient. What volume of deals is AngelList doing annually, and what percent market share does that imply in terms of total angel investment for a year?
I'm not exactly sure. The last numbers that I saw was from 2019, where AngelList funded approximately $2 billion worth of SPVs. And if you look at that overall in the venture community, that's not a lot of overall venture funding. But if you looked at angel investment, I think it's pretty significant. I mean, AngelList is the oldest one. They've been at this for over 15 years. There are new platforms for that, but I would guess in terms of angel syndicates, they're probably 70, 80% share in the United States. Okay. Some angel syndicates, like for example, Jason Calacanis, he started on AngelList, and he didn't because one of the things you have to do as a syndicate manager is, if I'm collecting 20%, AngelList gets 5% of that carry for managing the syndicate. So I'm only getting 15%. And Jason didn't like that, so he said, screw AngelList, and he started his own off AngelList syndicate called the Syndicate. And he now has like 7,000 angel investors, and he's collecting the entire 20%. So you could actually build the stuff that AngelList does yourself if you had a big enough deal flow. And The syndicate, Jason's syndicate, is writing approximately $60 million a year of checks into startups through syndicates. They're targeting about one deal a week. So they're doing about 40 or 50 deals a year for a total of $60-70 million just through that syndicate.
Okay. So how does, if someone's on the call today and they're, interested in dabbling more aggressively in this, how do they find you on Angel's List?
Well, you just go to incisive.vc, my website, and there's a tab there's called Join the Syndicate. And you click that and it takes you over to Angel List, and you create an account, and you're in the syndicate if I approve you.
Okay. I think it's highly efficient. It's going to be really interesting to see where this goes over the next couple of years, because it's a great way for people that want to expand their portfolio to participate in vetted deals from people like you.
And one thing I would caution to people, obviously, I think I'm a very thoughtful lead, but there are over 3,000 syndicates on Angel List, and many of them do not put the level of diligence or the level of capital that I put into a deal. When my whole thesis of starting Incisive Ventures was, I'm going to write checks anyway. If I'm going to write a $100,000 check, and I can get a $300,000 investment in the company, $200,000 for my friends, that's better for me because I'm putting more money into a company I'm already investing in. Many syndicate leads on Angel List are not deploying their own capital. They're just putting up options to invest in companies and trying to collect that 20% carry. So I would be cautious to join syndicates where you're not actually investing with the syndicate lead. You're just giving them a free option on your money. There's quite a few of those out there, and a lot of syndicate leads don't write their investment thesis and tell you what they're investing in and stuff like that. I personally, as an LP, think that's very valuable because I want to understand where this person's area of expertise is, how they make decisions. And if I agree, I'm happy to invest with them. But where I don't know what they're doing, don't know their network, don't understand how they make decisions, it's a lot harder for me to co-invest with them.
Good points. We have a question from Paul Sweigel. Paul, do you want to ask your question?
Yeah, sure. Thanks. Martin, I've worked with a lot of startups, and several have approached Angel List several times and tried to figure out which syndicate would be, a good prospect. And a lot of times it just seems like a dead end. It's hard to pierce through that. The syndicate managers are not particularly responsive. So any thoughts about getting through to syndicate managers and making progress through Angel List?
Well, send the companies to me, and I will tell you if I like them. If they don't fit my thesis, I will introduce you to a syndicate manager who I think is quality and will take the meeting. The reason you don't get a lot of response inbound like that is that most syndicate managers are really playing the game of, my buddy is a partner at Andreessen Horowitz. He gives me $100,000 piece of a round they're leading. I do that deal. They don't prospect and have a thesis around, particular industries like a traditional venture capitalist. They're really all about the free option on a guaranteed deal. And this is why most of them are not very responsive, because they don't really want to try to dig into a company to decide whether it's any good. And I mean, I think there's very few Angel List syndicate managers who actually do that. I know the ones that do that because I've met like 300 of them, and I can direct you to the right people. But that is definitely something that Angel List needs to figure out, is how to direct people to the more thoughtful syndicate managers who are actually trying to evaluate companies.
That's great feedback, because that's sort of been the experience. They're not really taking, invitations.
Their primary deal flow is, their friend who's a partner at another venture capital fund, and they carve off a little piece and get a free option.
And that's not what it looks like when you go to the AngelList website. It looks like it would be founder friendly, but it's sort of not.
Nope.
Just another
Not at
quick
all.
question. Do you feel pretty comfortable with safes versus convertible notes? Seems like you are comfortable with them.
Yeah, I am. I mean, the only time, I've preferred a convertible note is when a company went bankrupt and you had a debt lien against it, because you don't with a safe. Safes are a little more founder friendly, but basically, YC has standardized the safe, and it's an incredibly simple, easy to use thing. And I'm completely happy with safes.
Great. Thanks for those answers.
Thanks, Paul. Hey, we've got a couple more minutes here, but I want to transition to Spokane.
Oh, yeah.
You moved here. Your
did.
wife is from here, so that was kind of a hook. But now you're here. You've lived in Seattle. You've lived in other places. You've hung out in Santa Monica. What are the attributes that you see that Spokane offers to entrepreneurs, startups, tech companies? Any observations on what we could do to be a better entrepreneurial hub?
Well, I don't know if there's a lot that has to be, sort of the pandemic kind of a little. I think people's desire to be in big cities, given what's happened with the pandemic, and also given this rapid shift to remote, everything, it made secondary markets like Spokane that much more attractive. I've had probably 10 friends move from Seattle for all different reasons, but mostly because they can do their jobs remote now, whoever they're working for. And they now have freedom of choice of where they want to live, and choosing a little bit lower cost, more of an outdoor lifestyle, a little bit of, there's still wonderful, restaurants, things to do in Spokane, but you're much closer to the nature. You still have high-speed network. In my business doing investments, venture capitals used to be a very regional oriented thing where you had to really spend a lot of time with people. The pandemic, for better or worse, has made it, both from an investor side and a company side, much more normal to talk to people on Zoom and to talk to people, on a computer, and make decisions for material amounts of money without ever meeting somebody. That is a giant change from a year ago. And when you realize that, you say, then I can decide where I want to live. And I decided I wanted to live in Spokane, in part because the quality of life, I think, is far superior to Seattle or Los Angeles, despite the fact that I can't surf. I was surfing this morning in Venice, but maybe I'll fix that. Maybe I'll build one of those surf parks in Spokane where I can surf. But I love the quality of life. I like the quality of schools. We have a bigger house with more acreage for the family. And when you can choose where you want to live, I think a lot of people are going to choose to live in a place like Spokane versus the bigger cities.
We're delighted to have you here. Delighted that you're having a positive experience, because that goes a long way as well. I want to ask one last question before we wind down here. Now, you successfully hit the 2000 IPO window with Loud Eye. You missed it with Imperium in 2008. We're kind of in an interesting, frothy market environment now. How much longer do you think this window is going to be open?
I don't know. I can never, I'm not a good market timer. I think it's going to be open for quite a long time, especially because of the SPAC thing. And I'm on the board of 2 SPACs, but you've got something like $30 billion of capital sitting in SPACs waiting to do IPOs, which is not a front door IPO, but those companies have to deploy that money and convert into a thing. So even if the traditional front door IPO window closes, that money is going to be sitting there looking for a deal. For at least the next 2 years. So I think we're in a positive environment for a very long time. I mean, the SEC just tried to do something to sort of slow SPACs down a little bit yesterday. But until what closed the IPO window was the 2008 recession, and the IPO window closed in March of last year during the pandemic, but it reopened 6 months later. Could a second COVID surge, or could a war with China, or something else cause the financial markets to close quickly? Yeah. When's that going to happen? I don't know. But what gives me confidence is I think we're in a low interest rate environment for a long time. And I know that money's sitting there in the SPACs that has to be used. So I think it's a very positive time for a very long time.
Okay, well, I hope you're right. And I agree with your fundamental observations. Well, it's a couple of minutes after 2, so we're going to wind up here, but this has been fascinating. I mean, very informative. Great to have you in the community. I think you're going to be a great resource for other angel investors. I know there's a number of entrepreneurs here in Spokane that are on the cusp of raising new capital that want to meet with you, and you've been very gracious with your time in meeting with these people. So thank you. But before we go, I do want to highlight, we've got a couple of more programs coming up on May 5th. We have Aaron Richmond from Endeavor Capital, which is kind of on the other end of the spectrum. They're a private equity firm. And then on May 20th, we have the founder of Catalyst, which is the company that Martin referred to. He was a very large investor in it. Through my Kickstart funds, I put a little bit of money in, but it's a fascinating story, an amazing product. I've got 2 of them, somewhat following the Peloton Fight Club model. So, put that one on your calendar as well. So with that, thanks again, Martin. Thanks for everybody. And we'll see you at the future programs.
Thank you, Tom. Everybody email me on my website. I'm happy to talk. Take care.
Thanks, Martin.
Fantastic.